Today, everyone is focused on the correction happening in the markets. The S&P 500 index is down over 7% from its peak. Whether you look at it cap-weighted or equal-weighted, giving the same weight to every single stock. The NASDAQ 100, down over 10%. NVIDIA, the market's darling, is down 25%. The Russell 2000, which tracks smaller companies, down 15%. Corrections like these shake investors to the core. But are they a sign of something bigger or just normal market behavior? In this video, we're going to cover 3 things that every investor needs to understand right now. Number 1, why 2025 is shaping up to be an explosive year, like I said at the beginning of this year, but not in the way you expect. We'll talk about why corrections are completely normal and how to use them to check if your portfolio is set up properly. Probably not. And number 3, how do you position yourself for the year ahead? Real, practical strategies that work for regular investors with 6 to middle 7 figures in investable assets and at least a decade before retirement. I'm Dean Lolkin, investing veteran and private credit CEO, here to help you grow your wealth. Let's get into it. I bet when you think about 2025 today, right now, you probably assume a so-called normal 10% return is the best case scenario. Or, at worst, something terrible is going to happen with the S&P 500. And professional forecasters mostly agree with the normal return idea. Here's the reality. Markets rarely move in predictable straight lines. The setup we have right now at the start of a second presidential term for Trump, with 2 big positive years right behind us, this historically led to very big years, not average ones. But there's also a major risk we need to talk about. First, the bullish case. When this setup has led to huge gains, was 1985, Reagan's second term, plus 31%. 1997, Clinton's second term, plus 31%. And Obama's second term, 2013, 32%. Each of these years had 2 things in common: strong market momentum leading in and businesses that had clarity about the policy and economic landscape. That's when markets tend to run the hardest. Well, today we face a unique risk. Trade policy and America's global role are unresolved. Right now, it's fair to say businesses do not have full clarity at the beginning of March about the economic and policy landscape of 2025. A real risk. We have to acknowledge it. So the debate over trade policy is unfolding right now. And with tariffs, trade negotiations, potential changes to supply chains on the table, businesses are unsure how global trade will evolve. And same with investors. So America's role as the world's police force is being questioned. The ongoing back and forth over support for Ukraine and other geopolitical issues, this creates uncertainty in both defense spending and global economic alliances. If markets feel stuck in neutral, it's because they're not yet sure how these issues will play out for the economy. One thing we know is they will predict the outcome, markets will, ahead of time, so do not wait for clarity. There is no green light, and it probably will result in a year that isn't average. Corrections are normal. Here's the data that proves it. I know, a 10% pullback, which we haven't even gotten to yet, feels terrible in the moment. But let's put this into historical context. The numbers say one thing very clearly. This happens all the time. Since 1928, the market has had 22 bear markets. 10 to 20% corrections happen roughly every 2 years. Since 1975, we've seen 24 corrections, but only 5 turned into bear markets. The average correction lasts around 4 months and recovers within another 4 months. So here's the key takeaway. Most corrections do not turn into crashes. They're part of the market's natural cycle of volatility and the main reason that you can earn 10% returns over time, unlike other assets. Now, what you feel during a correction tells you a lot about you and your portfolio. Corrections are very useful. How you feel right now tells you whether your portfolio is properly structured for your goals or not. If this pullback right now is making you panic, one of 5 things is probably wrong. 1, your portfolio is way riskier than you thought. If a 10% drop makes you want to sell everything, you're taking too much risk. 2, you're not diversified enough. If your portfolio is moving like a single stock, it is not diversified. And if the word crypto is coming to mind, we've got serious problems. Number 3, you don't have a clear investment plan. Corrections feel chaotic when you don't know what your end game is and you haven't thought through the next 10, 20, and 30 years. And number 4, you're thinking short term instead of long term. Markets recover way faster than you expect. If you're reacting emotionally, you're focusing on the wrong time frame. And number 5, you're trying to time the market, jumping in and out, and that leads to worse returns over time. Market timing is one of the worst traps that an individual investor can possibly get stuck in. If you feel uneasy, use that as a signal. Something in your portfolio needs adjusting. So how do we position for what's coming next? Right? We've still got over 9 months left in the year. We've established why 2025 will be anything but average and why corrections are normal. Now let's talk about what to actually do about it. For regular investors with 6 to mid 7 figures in investable assets, that's $150,000 up to say $5 million, and 10 years or more before retirement, here's a practical strategy. I want you to remain mostly invested in large cap US stocks. Long-term, US stocks will provide stronger returns, but instead of only using a cap-weighted S&P 500 index fund like SPY or VOO, consider balancing that with an equal-weighted S&P 500 ETF like RSP. That gives you more exposure to non-tech sectors and smaller companies that are still quite large. I want you to add exposure to non-US dollar denominated assets as well that are kicking butt to start the year. Diversifying beyond the US dollar makes a lot of sense, especially in uncertain macro environments. A smart way to do this is through funds that track the MSCI World Index and emerging markets. Funds like, these are ETFs like EEM and EFA. You could allocate 15 to 25% of your portfolio very easily. Within your alternative asset allocation, beyond foreign stocks, you could also include real assets like gold and Bitcoin. And I recommend some single-digit exposure through simple, cheap ETFs. You don't need any weird crypto wallets. Private credit, first trust deeds, and other income-generating alternatives also might belong in your portfolio. Along with those alternative assets, never a bad idea to have some money market fund exposure, especially with the shape of the yield curve right now. It's very, very flat. Short-term rates are very similar to long-term rates. So why not go short-term and earn 4% or more on those money market funds? And if you want some flexibility, having 5 to 25% of your money in those money market funds, depending on your risk tolerance, can help smooth volatility without totally exiting the market. So what do we do right now? Let's bring it all together. 2025 is unlikely to be a boring 10% year. It's shaping up to be much bigger, up or down, which I don't think it'll be a down 25% year, but it could be a down 0 to 10% year. Corrections are normal, and they should be used as a tool to assess your portfolio, not a reason to panic right now. Make some practical portfolio adjustments. Balance your S&P 500 cap-weighted exposure with some equal-weighted exposure. Add some non-US dollar assets, and incorporate money market funds. That'll help you navigate uncertainty right now. I want to hear from you. How are you positioning your portfolio for 2025? Maybe you agree or you disagree with me. Drop a comment. And if you found this helpful, make sure you subscribe to the Dean's List. We're cutting through the noise and giving you the investing insights that actually matter. I'm Dean Lolkin. See you on the next one.